Okay, let's jump right in. Today we're going to unpack a very specific but really important corner of the accounting world, IFRS 5. This is the standard that gets pulled out when a company decides to sell off a major chunk of its business. We're going to break down what that really means for the numbers. I mean, just think about it for a second. Some huge company decides it's selling off its entire North American operation. What happens then? You can't just slap a for sale sign on it and call it a day, right? How do you tell your investors, hey, our core business is about to look very different? And how do you value something you're no longer using, but you're trying to sell? Well, that's exactly the puzzle IFRS 5 is built to solve. And that brings us to our first stop. We're looking at why these rules even exist. This isn't just about shuffling numbers. It's about painting a clear picture for everyone when a company is making a massive strategic move. So right off the bat, we need to get the language right. When a company sells off a big piece of itself, it gets a special name in the accounting world. It's called a discontinued operation. That's the big picture event. And the things inside it, the factories, the equipment, they get a new label too. They are now considered held for sale. Now, look at how specific this definition is. We're not talking about selling a couple of old company cars here. For something to be a discontinued operation, it has to be a major part of the company. We're talking about an entire product line, a well-known brand, or maybe all of their operations in a specific country. It's a big deal. So when does an asset officially change its status? Well, a company can't just wake up one morning and decide to reclassify something. It has to pass a really strict test. Think of it like a checklist to prove they are serious about the sale. And here is that checklist. Every single one of these boxes has to be ticked. You can't say an asset is ready for sale if you still have months of work to do on it. Management has to be all in, not just testing the waters. And look at 4 and 5. Those are huge. The sale has to be highly probable within a year, and the price has to be realistic. You can't ask for a ridiculous amount of money just to avoid selling it. You've got to meet all 6 criteria. So those are the rules on paper. But how does this actually work in the real world? Is there any wiggle room? Turns out, not really. Let's look at 2 quick examples. This illustrates it perfectly. The Switzerland operation, it passes with flying colors. The plan is solid, the intention is clear, all the boxes are checked. But then look at the France operation. It fails. And why? The asking price is way out of line with what it's actually worth. And because of that, the rules say the sale is not highly probable. So it can't be classified as held for sale. It really is that black and white. Okay, now for the main event. What happens to the numbers once an asset officially clears that checklist? This is where IFRS 5 really starts to make its mark, and it's where things get pretty interesting. And I'm not just being dramatic. The very moment that classification happens, 2 huge accounting changes get triggered. The asset is basically kicked out of the business as usual club, and how it's valued gets a complete makeover. This is the first bombshell. Think about it. We depreciate an asset, like a factory, because we're using it to make money. But the second it's classified as held for sale, the game changes. The plan isn't to use it anymore. The plan is to recover its value through a sale. So logically, depreciation just stops, dead in its tracks. No more depreciation expense hitting the books for that asset. So with depreciation gone, we obviously need a new way to measure the asset's value while it's waiting to be sold. And this is the second major shift. A whole new measurement rule takes over. And here it is, the new golden rule. The asset must now be valued at whatever is lower, its current book value, what we call the carrying amount, or its market value minus the costs to sell it. Let's break down what that actually means. Let's keep this simple. The carrying amount is just what the asset is worth on the company's books right now. Fair value less cost to sell is what you could get for it on the open market today, minus any direct fees like legal or broker costs. The company looks at those 2 numbers and has to use the lower one. And if the market value is lower, they have to write down the asset's value, and that difference is recognized immediately as a loss. So we know the rules, we know how the value changes, but where does an investor actually see all of this? The final piece of the puzzle is all about presentation on the financial statements. You see, the whole point of IFRS 5 is transparency. Anyone looking at the company's financials needs to be able to easily tell the difference between the assets that are part of the ongoing business and the ones that are headed for the exit. And here's exactly how they do that. On the statement of financial position, you probably know it as the balance sheet, these assets are pulled out of the regular categories. They get their very own separate line item.
You can see it right there. Non-current assets classified as held for sale. It's designed to be impossible to miss.
But business deals aren't always straightforward. Plans change. So what happens if a company goes through this whole process, classifies a division as held for sale, and then the deal falls apart? This is a really important what if. An asset can't just sit in this held for sale limbo forever. If the criteria from that checklist are no longer met, say management just decides to pull it off the market, then the accounting has to do a U-turn. So that special held for sale status is officially revoked. The asset is brought back into the fold and becomes a regular part of operations again. But, and this is a big but, you can't just flip a switch and go back to its old value. There's one last rule to follow. And here's the final measurement test. The asset is remeasured at the lower of two different numbers. First, you calculate what its book value would have been today if you'd never stopped depreciating it in the first place. Then you figure out its recoverable amount, basically what it's worth right now. The company has to record it at whichever of those two figures is lower. It's a safety net to prevent companies from putting an overvalued asset back on their books. So, let's just quickly recap the big ideas from IFRS 5. First, there's that super strict checklist you have to pass. Second, once you pass, depreciation stops. Third, the asset gets a new, more conservative value. And finally, it's broken out separately on the balance sheet so everyone can see it. And all of this brings us to the big, final question. What's the point of all this? Well, by separating out the assets and operations a company is getting rid of, the goal is to give investors a much clearer, more honest view of the core business that's going to stick around. And whether it truly achieves that clarity, well, that's the ultimate test of IFRS 5.